Hello, everybody, and welcome to exercise 1413. So this is Matt Perry, a friend of ours, has outstanding 6 million of 11% bonds, interest payable on July 31st and January 31st, due in 10 years. On July 1st, it issued 9 million of 10% 15-year bonds at 98. A portion of the proceeds was used to call the 11% bonds with an unamortized discount of 120 at 102. On August 1st. Okay, so for this one right here, let's go ahead and deal with the issuance of the new bonds. So on July 1st, we issued 9 million. So go bonds payable. So our bonds payable always is going to be at the face value. The amount of cash we received by issuing these bonds was, basically it's at 98, so 98% of this. That means the cash that we received, and then you're gonna have a discount on bonds payable for the difference of 180. And so that's how we would go through and record the initial issuance of the bonds. So now we need to go through and then redeem the other bonds. So we had outstanding 6 million of 11% bonds, and there was an unamortized discount of 120,000. So when we have a discount on bonds payable, when we redeem a bond, we need to go ahead and essentially get rid of the carrying value of that bond. So if the bond payable had a face value of 6 million and had a discount on bonds payable of 120,000, what I need to do is to make these go to zero. So for the bond redemption on August 1st, so over here, I'm going to be debiting bonds payable. I'll debit bonds payable for the 6 million. I'm going to be crediting discount on bonds payable for 120,000. I have to make this go to zero now that I'm redeeming it. The amount of cash that I'm spending to redeem the bonds is at 102. So the amount I'm spending is going to be 6 million times 102%, or right over here, $6,120,000. And so the loss on redemption of bonds payable is going to be $240,000. So that's how I'm going to go through and do this. So whenever I issue a discount, and this is just really important to remember, this is always going to be the form of the journal entry I use to record a bond being issued at a discount. So that's never going to change for us. Right over here, when I'm redeeming a bond, I have to take that bond off of my books. Any unamortized discount, I also have to eliminate too. And the cash is going to be kind of given to me at what I pay to redeem them. And there you go. So let's see if we did that one correct. Got the first one right. And the second one, we also got right as well. Okay, so let's just keep on going. So entries for exercise 1414 on June 30th. Let's see here. So let's go ahead and hide this away. So this is exercise 1413. And now let's go to exercise 1414. So on June 30th, I issued 12% bonds with a par value of 800,000 due in 10 years. They were issued at 98 and callable at 104 any date after June 30th. Because of lower interest rates and a significant change in the company's credit rating, it was decided to call the entire issue on June 30th, 2021 to issue new bonds. So let's go through and prepare the journal entries to record the redemption of the old issue and the sale of the new issue on June 30th, 2021. But let's go ahead and do what we did initially on June 30th, 2012. So when I issued the bonds, I received cash. So my bond payable was $800,000. The amount of cash that I receive is going to be 98% of this amount. And my difference is going to be a discount on bonds payable. And this is going to be the difference between these $2 amounts, or at $16,000. Okay. So let's take a look over here at our discount on bonds payable. Okay. So our discount on bonds payable was initially $16,000. So this was on June 30th. Okay. And they're CalDOT 104. Because of lower interest rates and a significant change in the company's credit rating, it was decided to call the entire issue on June 30th, 2021. So how many years later is this? This is going to be, so we've got here, so that they were issued on 2012, 2013, 2014, 2015, 2016, 2017, 2018, 2019, 2020, and they were called in 2021. So this is 1, 2, 3, 4, 5, 6, 7, 8, 9. Okay. So here, the bond is a 20-year bond, and it's being amortized straight line. So the amount of the amortization so far is going to be $16,000 divided by 20 years, or $800 per year. So the amount of amortization that I've done, right, and whenever an interest is being paid on this, they're at 12%. So what I'm going to do here is so every single year, I'm debiting interest expense, crediting discount on bonds payable for $800 because I'm amortizing it, and then I'm crediting cash, and this is going to be at 12%, or the face value times the interest rate. And so my interest expense will be over here. So this is what I'm going to be doing every single year. So, but now I've gone through over here and I'm redeeming it after 9 years. Okay, so the unamortized discount after 9 years, this is going to be 800 times 9, or 7,200. This would be 630, 13 through 630, 21. So my ending discount, my unamortized discount on bonds payable is going to be 8,800. So, so over here, decided to call the entire issue on June 30th and to issue new bonds. Okay, so the cost to me to redeem the old bonds was going to be 104, okay, or 104%. So the redemption, the amount of cash that I'm going to be paying out is going to be the face value of the bonds, or 800,000 times 1.04, or $832,000. The next thing I also need to do too is I also need to get rid of the unamortized discount. So this is going to be the 8,800. Okay, I'm crediting bonds payable for the full face amount of 800,000. So my loss on redemption of bonds payable is going to be, let's see here, 832 plus 8,800 minus 800, or 40,800. Just make sure that these add up. There we go. So that's my loss on redemption. So that's how I record the redemption. I've got to take the old one off the books, have to remove the unamortized discount, meaning whatever amount of discount that I have not yet amortized. Cash is going to be 104% times the face value. And then this is going to be my balancing entry. So that's going to be my balancing amount. So then over here, okay, issued new bonds. So then 10% bonds are sold the amount at 1 million at 102, and they mature in 20 years. Okay. So over here, so on 6/30/21, I'm receiving cash. Okay, they were sold at 1 million at 102. Okay, so 1,020,000. Okay, so the bonds face value, the new bonds are 1 million. So this is going to be a premium on bonds payable for the difference of $20,000. Okay. Now here's some fun stuff. Okay, so these bonds here, so this is how I would go through and record the old bond redemption, which we did that correctly, and then the new bond over here. Okay. So with these new bonds, they're 20-year bonds, and they pay interest semi-annually. So this is a lot of fun. Okay. So when I get to December 31st, 2021, whenever I pay interest and I'm in a premium situation, it's always going to be the same. I'm going to debit interest expense. I'm going to debit premium on bonds payable, and then I'm going to be crediting cash. This is always the journal entry form that I'm doing to record interest expense. Why? This premium has to go down to 0 by the end of it. So right over here, the amount of the cash for interest is going to be the face value of the bond. My interest rate is at 10%. But note here, whenever you see an interest rate, it is always an annual rate. So what I'm going to do here, because interest is being paid twice per year or semi-annually, I'm going to multiply this by 6/12. So the cash paid for interest is going to be $100,000, but I multiply this by 6/12 or by 0.5. So the cash I'm paying for interest is going to be $50,000. Then for my premium on bonds payable, which is $20,000, I need to divide this by the number of times interest is being paid. Well, interest is being paid over 20 years, and it's being paid twice per year. So I'm going to have 40 interest payments, or 20 years, 2 times interest payments per year. So I divide this by 40, I'm going to get $500. So I'm going to debit my premium on bonds payable for $500. And then over here, I'm going to be debiting my interest expense for $49,500. Of course, I'm missing my journal entry descriptions, but I think you all know what that should be. So that's how I go through and record my interest expense. So I recorded the payment of the first 6 months interest and the amortization of the premium. Okay. So let's go to this last one here. This is a lot of fun and excitement. I'm having a great time at 11 or 10, what time is it right now? 10:54 p.m. on December 28th, 2020. Wow. Okay. This is how I'm spending my holidays with bond premium amortization. It's exciting. Okay. So let's go over here. So day company have bonds outstanding with a maturity value of $300,000. On April 30th, when these bonds had an unamortized discount, they were called in at 104. To pay for the bonds, we had issued bonds a month earlier at a lower interest rate. The newly issued bonds had a life of 10 years. The new bonds were issued at 103, face value 300. Ignoring interest, compute the gain or loss and record this refunding transaction. So it's really 2 separate transactions. So the first one is going to be on 3/31/20, I received cash of 300,000 times 1.03 or 309,000. The bond payable is always recorded at the face amount. And then over here, I'm going to have a premium on bonds payable for the difference of 9,000. Okay. So that's what I did. That was like my newly issued bond. Okay. So, however, I redeem the old bonds. So what I have to do is similar to what I did on some of these other questions before, is I have to get rid of what is on the books. So what was on the books over here is I had a discount on bonds payable. My unamortized discount was 10,000. And my bond payable was 300,000. Okay. So my redemption on April 30th, 2020, got to take the old stuff off the books. I'm going to debit bonds payable. This is going to be for 300,000. I'm going to credit discount on bonds payable. Over here at 10, I had to pay cash at 104% of the amount. So this is going to be 312,000. So over here, my total debits are 300,000. Total credits are 22. To balance this, I have a loss on redemption of bonds payable. So that is going to be the loss on bond redemption. And let's see if I did this right. Hopefully I did, so I don't have to redo the video. Yep. We are good. So that was bonds, known as James Bond, but I don't think any of you are aware of who he is anymore in the popular culture, but it's okay. In any event, have a great one, and I look forward to seeing all of you on the next video. Have a good one.